Hello everyone and welcome to this video in the Learn Technical Analysis series brought to you by thetechnicals.com. Today we're talking about one of the essentials of financial chart reading, identifying chart patterns. These are simply shapes that occur on financial charts which can provide solid potential trading opportunities. But before we get to that, as always, just a quick risk disclaimer. Trading in the financial markets carries a high level of risk and may not be suitable for all investors. Before deciding to trade in the financial markets, you should carefully consider your investment objectives, level of experience, and risk appetite. Okay, let's get started. So, what exactly are chart patterns? Well, first of all, there are hundreds of chart patterns or shapes identified in the field of technical analysis. But most of the time, usually simpler is better. So we like to concentrate on a handful of basic, reliable patterns that tend to work time after time. Now, there are two main types of chart patterns that I'm going to talk about today. One is the continuation pattern, and the other is the reversal pattern. Continuation patterns often continue a trend on a breakout of those patterns. Reversal patterns often reverse a trend on a breakout of those patterns. Now, a pattern is no good without a price breakout of the pattern. So in terms of the continuation patterns and the reversal patterns, we're looking for some type of a breakout to provide us with a trigger or the opportunity to get into a long or a short trade. Patterns are usually price consolidation zones just waiting for a volatility move. And that's the opportunity we're looking for. Now, while chart patterns are not crystal balls, they can provide solid trading opportunities. So here are some of the most important continuation chart patterns. Please keep in mind that these generally continue a trend, but they don't always do so. Okay, so these are the continuation chart patterns. As we can see on the left-hand side here, we have the triangles. We have three different types of triangles. Over here on the left-hand side, we have the ascending triangle. We have price moving up into this consolidation of this triangle, and then a breakout above the upper border of the triangle gives us an opportunity to go long or to buy on a breakout of this consolidation, continuing the previous uptrend. Ascending triangles are biased slightly to the upside. Now, same thing with the descending triangles, but to the downside. We have a down move, a downtrend, and then we have some type of a consolidation here in this descending triangle. We're looking for a breakdown below this descending triangle, below the lower border of this triangle, looking for a shorting opportunity in the direction of the previous downtrend. So we're looking for some type of consolidation here and a breakdown, and these are biased. The descending triangles are biased slightly to the downside. Now, for the symmetrical triangle, which is not biased either way, we are looking for the previous trend and then looking for a breakout in the same direction as the previous trend for a continuation of that trend. So triangles are essentially just consolidation zones within trends, and we're looking for breakouts of those consolidation zones in order to continue the trend and to look for potential opportunities to get into trend trades. Now, flags and pennants are much the same. We see here on the flags, right here on the right-hand side, we have a move to the upside with this trend, and then a slight pullback and consolidation, and then a breakout above the upper border of this flag gives us an opportunity to go long in the direction of the trend. So it's a trend and a pullback and then a breakout to the upside. We're looking to continue this trend. Same thing to the downside, but in the opposite fashion. We have a move to the downside, we have a downtrend, and then we got a pullback to the upside and a breakdown below the bottom border of the flag. And that breakdown gives us a trigger to go short in the direction of the trend on this continuation flag. Same thing with the pennants. Pennants are just slightly different from flags in that they're shaped sort of like little triangles as opposed to little rectangles. So here we have a move to the upside with this pennant pole, and then we have a slight pullback or consolidation, and then a breakout to the upside gives us an opportunity to go long in the direction of the trend. Same thing to the downside. We have a down move and then a slight consolidation in this little triangle, and then a breakout to the downside gives us an opportunity to go short in the direction of the downtrend. Here are a couple more continuation patterns. We have wedges and rectangles. Here on the left-hand side on the top, we have the falling wedge. So what we're looking for here is a move to the upside, a trend to the upside, a pullback in the form of the falling wedge, It's a consolidation as well, and we're looking for a breakout to the upside above the upper border of this wedge to give us a continuation in the direction of this uptrend. Same thing, but in the opposite fashion for the rising wedge. We have a move to the downside, we have a trend to the downside, we got a pull back to the upside in the form of this rising wedge. We're looking for a breakdown below this lower border of the wedge in order to give us a potential shorting opportunity to go short in the direction of the downtrend. Same thing with the rectangle, although the rectangle is not biased either to the upside or the downside. We are looking for the previous trend if we're looking for a continuation pattern. So in terms of this rectangle, if we have a move to the upside and then a sideways consolidation within this rectangle, we're looking for a breakout to the upside to give us a continuation of this uptrend. Same thing if it were to come from the upside, come down. We are looking for a consolidation and then breakout to the downside to continue the downtrend. So those are wedges and rectangles. Now here are some of the most important reversal chart patterns. As we can see here, we have doubles, triples, and head and shoulders. Over here on the top left, we have a double top. So what is a double top? Basically, we see price hitting a high up here. It comes back down, it hits a trough. It hits another high that's at or around the same high as the first one, and that is a retest, and that's the double top. Once that occurs, we could draw a line under right at the trough of the double top, and we're looking for a breakdown below that trough to give us a potential opportunity to go short on a reversal of this pattern. Okay, same thing with the double bottom. We have price hitting a low and then hitting a peak up here, hitting another low that retests that previous low. That's the double bottom. Then we could draw a line, a horizontal line at the peak, and we're looking for a breakout above that peak to give us an opportunity to go long on a reversal to the upside. Okay, same thing with the triple top and triple bottom. With the triple top, we have a high hit here, then we have a trough here, then we have a retest of the previous high, then another trough, then another retest of the previous high, and then a breakdown. We're looking for a breakdown below the lowest trough, and that gives us the opportunity to go short on a reversal to the downside. Triple bottom, same thing, but in the opposite fashion, we have a low hit here, then we have a peak, then we have another low, another peak, then another low, retesting the prior two lows. We're looking for a breakout above the highest peak in order to give us a potential opportunity to go long on a reversal to the upside. Head and shoulders are somewhat different. We have a left shoulder here, we have a head here, we have a right shoulder here. Once that occurs, then we could draw what's called a neckline. Once we draw the neckline connecting the troughs, then we could look for a potential opportunity to go short on a breakdown below that neckline for a reversal to the downside. Head and shoulders bottom, same thing. We have the left shoulder here, then we have price hitting the head here, and then the right shoulder here, and we have the peaks in between. We could draw a line to connect those peaks to draw the neckline. We're looking for a breakout above the neckline to give us a potential opportunity to go long for a reversal to the upside. Now, chart patterns are among the most important tools that you could use when reading charts and trading in the financial markets. They could provide high probability opportunities to trade, whether on a continuation of a price trend or a reversal of a trend. Please visit thetechnicals.com for more trading and technical analysis education. Thank you very much.